Welcome back, everybody. Another week, another wealth webinar. Today, we are going to literally do something that I think is so vital, and that is teach all of you how to take back control of your money by teaching you the basic fundamentals of you being your own bank. But one of the things we're going to do is we're going to talk about how you sometimes have to give up to get ahead. Now, let me just ask all of you a question. This one should land. Doesn't it feel a bit strange out there? Aren't things getting a bit scary? It doesn't matter what news you turn on or what Instagram or Facebook post you read or who you follow. Like, things are just a bit off, I think is a safe way. Some things just don't make sense, right? Now, I know when we do this wealth webinar, we always have a very diverse group of people. We have people who are here for the first time, people who have been here hundreds of times, and people who maybe 2 or 3 times. But it's just getting weird. And I've been talking about a lot of this for a long time. I've been talking about the patterns. I've been talking about the cycles. I've been talking about the signs like inverted yield curves, reversion of the yield curve, the bond market and how it's acting very strange, which is always a signal. I've talked about all the statistics that follow all of these different signs. They all lead to one place. And I think we're finally starting to see that. I still think it's a bit early, I'm not going to lie, but we're starting to see the cracks in the foundation. We're starting to see an economy that was really, really humming along. Some would even say overheated. We're seeing that thing cool down a little bit. We're starting to see unemployment numbers going up. We're starting to see lack of liquidity. Just today, we started to see some real weakness in private credit. What does all this mean to you? Well, it means whatever you allow it to mean. It means something different to each and every single one of you. But the core message I'm trying to get across to you is something's weird and something is happening beneath the surface, and you don't want any part of it. So here's the thing I'm going to tell you. And I just got back from Texas. I was at an event out there, and we talked a lot about this. It was a very high-level mastermind. And we talked about getting in a hurry to actually prepare yourself. Not getting in a hurry to make money, not getting in a hurry to make this thing happen, getting in a hurry to get yourself ready, because this is either going to be one of 2 different things for all of you. This is either going to be one of the greatest opportunities of your lifetime, or this is going to be a very painful, costly learning experience for you. And I don't want to get into the meat and potatoes of that, but I do want to preface that we're going to help you. That's the single most important thing. Today, and on all these trainings and all my YouTube videos, we're going to help you. That's our commitment to you. And you know what? We want to. This is what we do every single day. But the crazier it is out there, the louder it is out there, the scarier it is out there, the calmer and quieter it is in here. Because when you learn how to take back control of your money, which is not difficult, and when you learn how to become your own bank, everything slows down, everything gets really calm, and you start to see everything differently because you control the outcome. So folks, because there are so many people here for the first time, what we're going to do is we're not going to jump right in to the main topic. And the main topic is why IBC works long-term, the wealth timeline, and why the wealthy families and the wealthy people are playing a different game and how you can play that same game. That's the main fundamental topic of today. But because there's so many of you here for the first time, I would be remiss not to take you back to the foundational level. So many people try to build wealth. They try to build their financial, future, but they try to build it sort of just by throwing it together. Oh, I'll do a little bit of this. I'll do a little bit of that. What you must do, just like building a house, just like building a building, you must build the foundation. Today, we're going to go over the foundational aspects, and I'm going to do it as quick as possible because, listen, I got it all drawn right here. The infinite banking concepts, okay, also known as privatized banking systems. They are the same, okay? Back in the old day, it was called privatized banking, okay? In today's world, ever since R. Nelson Nash published the book, Becoming Your Own Banker, we know of it as the infinite banking concepts. Now, some of you don't know anything about what that means. So let's get back to the infinite banking concepts. I want to give you the foundational understanding of what is the infinite banking concepts. First thing, it is not a product. Although we will talk about one product and one product only, it is not the product that will make the difference. It is the process. So that is what the infinite banking concept is. It's a process that allows you to take back the banking functions in your life. Now let's break down banking functions. Every single one of you will have in your lifetime a greater capacity for financing than any other financial thing you're going to do. What I mean by that is you will finance more things throughout your life than anything else. Okay. So we might as well learn how to take back that banking function in our life. And here's the other thing. You already finance and give up interest on every single thing you buy, whether you finance it or pay cash. Now, there's only two things that happen for every single one of you. You make an income, you either spend it and it's gone forever, or you save it. You can't disagree with that, right? You make money, money comes in the door, you deposit that money into a bank. From the bank, you do one of two things. You spend it or you save it. Okay. Now, from there, a lot of us, when we save money for a purpose, to buy something. But a lot of people have been told from their family, from the Dave Ramseys, the Kiyosakis, maybe not so much Kiyosaki, but you've been told that the best thing you can do is pay cash for everything. And I'm not disagreeing with that. But when you pay cash for anything in your life, if you save up to buy a car and you pay cash for a car, do you know that you are paying interest? When you save up money, okay, the saving bucket, you put the money in the bank, you save it to buy a car, you are giving up interest because this money that you saved can no longer earn for you for the rest of its life. It's gone. It is into whatever the thing is. I'm just going to pick on a car. You buy an item and you pay cash for it. That money no longer works for you. Okay. So you gave up the interest earning potential on that money. That's number one. Number two, a lot of people will go out and they will lease or finance a car, furniture, houses, and things of that nature, to which then you make monthly payments of principal and interest. You're giving up interest on a monthly basis to someone else's bank. So I think we can all agree that no matter what you're doing in your life, you are paying interest. You're either giving it up or you're physically paying it. We're going to change that today. I'm going to show you how by changing one thing and adding one step, you can take all of the control of those two elements back. Let me define that. You can earn on that savings 24/7, 7 days a week, and never interrupt the compounding nature of that account. In other words, your money can find a way to earn for you for the rest of your life, never missing a beat, but still give you the ability to use that money to go buy the things you want to buy. So now we no longer give up the interest earning potential of that money. That would be a win right from the get-go. But number two, what we're going to do is we're going to find a way that every dollar that leaves your household has a way to come back to your household. We are literally like a boomerang effect. We're going to put money out there, and then that money's all going to come back. Now, let me just kind of show you a simple explanation of this. But let's talk about the product first, because the only way that can happen is if you change where your savings goes first. Notice I didn't say all your money, because you pay bills, you have expenses, you buy Starbucks, you buy diapers. That's still going to all come from your checking account. You're going to have income that's going to come in. That income is going to go into a checking account. From there, you're going to pay all your living expenses. But what we're really talking about today is the part of your income that you save. This amount that you save. And I don't care where you save it. We're going to change that. So let me give you some rules. If you save in a bank account, we're going to change where that money goes first. If you save in a brokerage account, we're going to change where some of that money, if not all of that money, goes first. If you're saving in a 401k, which is probably most of you, what we're going to do is we're going to look at how much your match is, 3 or 4%. We're going to keep that going to your 401k, but then we're going to potentially reallocate or change where the difference goes first. The only caveat to that would be is if your CPA said, no, you have to keep it going to the 401k because the economic benefit of the tax savings outweighs everything else in your life, which then I will show you mathematically that it does not in most cases. But everybody's tracking where we're going. We're going to change where it goes first. And we're going to put it into an account, and you can probably see what it is, but I'm just going to explain this. An account that provides you a guaranteed interest rate. That interest rate can never change for the rest of your life. It is contractually guaranteed. You're also going to receive dividends every year. They are not guaranteed, but they have never, ever, ever not paid one. Okay? So the interest and the dividends by today's numbers will be anywhere between right around 5.9 to 6.6%. That's the range that this institution is paying today. It's called the dividend crediting rate. But not only that, you're going to earn that interest and dividends tax-free. So your internal buildup of this account is going to grow tax-free. That's pretty cool. You don't have to pay the government any taxes on the growth in your account. It's going to be protected against judgments and liens in most states. And this next one, I can't preface how important this is for you guys to get real with yourself about this. It is private. Let me repeat that. It is private, meaning you never need to disclose this to anybody. You don't need to tell the government about this. You don't need to tell the IRS about this. It is 100% private. Your bank account is not private, but this is. Not only that, you control it. It is efficient and it is certain and provides certainty to you. Not only that, there is no volatility, none whatsoever. It can do nothing other than go up. There will be more money next month than there is this month. There will be more money next year than there is this year. Nothing else can happen. It cannot do anything other than that because it is guaranteed in nature. And not only that, it is self-completing. Let me just give you a story. One of my clients just left today. She flew in from Texas to do some recording and stuff. Kind of a hard one for me to talk about. It's really fresh and new, and it's too new, actually. So not long ago, her husband, who I knew very well, I knew them both extremely well for many, many years. He underwent a battle, a very long and difficult battle with cancer. And he was not, just like every cancer patient, he was not somebody that I thought would be the type of person that would get cancer. He was in great shape, like ate healthy, all those things, like just checked all the boxes, but he got a very rare form of cancer. And as you probably are guessing, he did not make it. So they were absolutely committed to the infinite banking concept. They were their own bankers. They were big into real estate. They did a lot of real estate deals using their private banking system. When he became ill, she had to leave her main business, just kind of almost shut it down and go take care of him. And she doesn't regret a day of that. When the day came where, she knew and they knew that he wasn't going to make it, he passed away. That life insurance policy, that account that we're talking about here, the specially designed and engineered whole life policy, paid out a tax-free death benefit to her. She sat here just a day ago crying, and it was one of those moments, because she said to me, Chris, without this, I would have been bankrupt. Without this private banking system that we use all the time, I would not be able to continue my lifestyle. So folks, what I'm trying to get at is I'm not trying to give you a sob story or a story that's sad. I'm trying to say it self-completes. Your bank account does not self-complete. Your 401k does not self-complete. Your brokerage account with your advisor does not self-complete. This self-completes in a tax-efficient manner. Not only that, it self-completes if you become ill. If you become, if you come down with a critical or chronic illness, there is also a bucket of money you can pull from to pay for that care. But what is this account? You all probably know this, but some of you don't, because some of you are here for the very first time. Like, if you didn't know what I was talking about, you'd be like, wow, that sounds pretty darn good. Like, what is this place where Chris is saying we should put our money? It is a specially designed and engineered whole life insurance policy from a mutually owned company. That's the product, folks. But it's not about the product, because when you hear the word whole life insurance, you got this icky feeling. You got this bad feeling. I did too. Trust me. I was an advisor. We did not like whole life. Whole life bad. Investments good. Buy term. Invest different. Whole life bad. That's how we were trained as advisors. But whole life, when I told you what it does, sometimes in life, it's not what it is, it's what it does. When I told you what it did, guaranteed interest, dividends, tax-free, internal growth, protection, private, control, efficiency, and certainty, no volatility, no restrictions, and self-completing with critical and chronic illness, like all of a sudden, that starts sounding pretty good compared to your bank account, which, what does your bank account give you? Some of you might say, well, Chris, my bank account gives me security. I got FDIC insured. Okay, up to 250, I'll give you that. Liquidity, I can take the money out when I need it. Okay, I'll give you that. The bank pays me interest. I get that. Okay, I'll give you that. Chris, when we go into the bank, we get burnt coffee that's been sitting there all day. I'm like, no, I'll definitely give you that. You come by our office, we have better coffee. Okay. It's not burnt, fresh, fresh. But anyway, let's get back into it because I'm going too long here. The purpose is not just to put your money into this specially designed whole life. The purpose is to make that money go to work for you a second time, because this is the beauty of this. When you put money in these specially designed whole lives, immediately in the first 30 days, let me repeat that, immediately in the first 30 days, you have access to your cash value. And every policy we design, we take a big reduction in our commission, 60 to 90%, so that you have high early cash value to which you can use. So the goal is, what we're going to do is we're going to take that money out of this account, and we're going to flow that money over here to the other side of this circle in an area that I like to call an opportunity zone, because this is where your opportunities live. And for all of you, this is going to be different. For some of you, the biggest opportunity of your life is your debts. You didn't think I was going to say that, did you? You're like, debts, opportunity, you're not connecting the dots. But what if I told you that your debts and paying your debts off is your number one path to building wealth? And I'm going to show you how to do that. But also financing and lending. We talked about that. This is all opportunities for you. Financing, when you buy a car, is not an opportunity in most people's lives, but now it is, because you get all the money back for every car you buy, drive, and own with this. Business uses, funding your business, investments, real estate, it's infinite. So the money is going to come out of the policy. Now, I'm going to go fast. The money is going to come out of the policy, but whose money is going to come out of the policy to use for the opportunity zone? Is it your money? No, it's the insurance company's money. See, the insurance company in your contract clearly states one thing: when you die, they will pay a death benefit. But what they don't tell you is that life insurance companies, unlike banks, life insurance companies have to actually have the money in surplus to pay the death benefit, because they never know when you're going to die. So you could die tomorrow, and they better have that money readily available to pay your beneficiaries. So therefore, they got this giant pool of money called surplus, their general account. And that surplus money, they want that money to go to work. So what they allow you to do is they allow you to use your death benefit, part of your death benefit, up to, and be very clear about this, up to the amount of cash value you have in your policy. So let's just say you started one of these whole life policies. You changed where your savings went first. You put $1,000 a month, and I'm just making numbers up, into this account. And after 1 year, you had 12,000 bucks. So then what you do is you need $10,000 because we want to pay off some debt. You take a loan from the insurance company for $10,000 of the 12,000. You had 12,000 in there. You took 10,000 out. How much is left in your account earning guaranteed interest and dividends? If any of you said 12,000, you're absolutely correct. Your full amount. But the 10,000 you took, what happened? Well, the insurance company from their general account advanced you part of your death benefit. They literally subtract $10K from your death benefit. They give it to you. Yes, they do charge you interest. So let's just use a hypothetical 5%. Now, 5% is not what your rate will be. It's just a hypothetical number. Your rate could be under 5, could be a little more than 5. I'm just using 5 as an example, okay? And let's just say your dividend crediting rate, and again, this is another example, because remember I said they're 5.9 to 6.6, is 6%. How does a bank make money? A bank pays you interest on the money that you leave at the bank in deposit. At least they should pay you interest. So let's just say the bank pays you 1%. If you go back to that same bank to borrow money for anything, can any of you get a loan for less than what you're paying in interest, or what you're getting paid in interest? In other words, if you earned 1% at your bank, could you get a loan for less than 1%? No, it's always going to be more. The bank is going to charge you at least 2 if they're paying you 1, and they're going to make a spread. But now we're reversing that because we're becoming the bank. We're using an insurance company. We're using a very different system. But if you're making 6 and you're paying 5, you indeed are the benefactor of the spread. Point number 1. But we got 10 grand to use, and our 12 grand is still compounding and going up. So we're going to use that 10 grand. We're going to come over here. We're going to pay off debt. Let's just say we had a credit card for 10 grand, and that credit card was costing you $500 a month. Just giving you an example. So we pay the credit card off. And also, I forgot something. When we take the loan, this is very important. That money is going to go into a segregated bank account. In other words, you're going to go to your local bank, wherever you bank. You're going to open up a second bank account, but you are going to tell them no debit card, no checks. We just need a place to hold money. The insurance company is going to send the 10 grand to this designated segregated bank account, creating books and records for you. Then you're going to take that same 10 grand and you're going to come over here and you're going to pay off this debt. Now you no longer owe interest on that debt. So let's just say the debt was 20% credit card. Okay, you were paying $500 a month. And yeah, that's, I think, all we need to know. Yeah, and you paid down 10K. So this is what we paid off. So now what we're going to do is, because we are the bank and we can't steal from our bank. You used to give that credit card $500 a month. We're going to change where that $500 goes. You're no longer going to write Visa, Amex, or Discover on a check every month and send it to that credit card. You paid the credit card off. Your private banking system paid it off. So now you're going to change the name on the check. The name on the check is going to be, well, insert your name, Paul Temple. Paul Temple is going to be for $500 a month. That money is going to come back, and every month it's going to go back into this segregated account, which is really the exact same cash flow as before. If you paid the credit card off and you did nothing, where does the $500 sit? In a bank account. Because you didn't have to make the payment, so it sits in your bank account. But we're going to change the bank account where it goes, and we're going to put it here. And then what we're going to do is we're going to redirect it back to your private bank, repaying part of the loan. Here's the cool part. If you did just that, you put money in, you took it out, you started paying down debts, you took the amount you were paying the debts and you recycled and recaptured it over to your policy. Here's what happens. Every month, your policy has $500 more, not a penny less. You had zero dilution of that $500. You got $500 available for you to use. You no longer owe somebody else. So that's good. You've recaptured $500 in cash flow. But the other thing you did, you actually are making the equivalent of 20% on your money. Let that sink in. If you're giving up 20%, if you're giving away 20% in interest on a credit card, and you no longer have to make that payment to the credit card, but you make the same payment back to yourself, isn't it indeed the same? If you're giving them 20%, you're giving yourself 20%. So you are making a return on your money. But here's where it gets really fun. Remember I said you were making a spread. Well, this gets even better because now your spread, you are in control of that spread. We borrowed 10 grand from the insurance company at 5%. This is super cool, and we have software that does this, but I'm just going to go back to my software called a calculator. Craig, you wouldn't know what that is. You know, it's not an Excel sheet or anything like that. It's just a calculator, okay? And what we're going to do is we're just going to do some simple napkin math. And every one of you know how to do napkin math, right? And I love that we got Primerica being thrown out in the chat there. We'll cover that in a little bit. So here's the deal. $500 comes back to your policy. Every single month, $500 is reducing the loan you took from the insurance company, but you never gave up any of that. So let's just do the math. We're going to do 500 times 12 months. So I'm going to show you a 12-month time frame. I think you guys can see that. $6,000. So in 1 year, we paid down $6,000 of the loan to your policy. So now all of a sudden your policy is owed $4,000. Now remember, we started out at $10,000 loan and we were paying 5% interest, which means we were giving away $500 in interest to the insurance company here. But now after 1 year, losing zero liquidity, actually taking back money, we owe $4,000. And 4,000 times 5% is $200. So 200 divided into 10,000, see if I'm doing this right, is roughly 2%. So remember, we started at 5%. The equivalent, hopefully I did my math right, the equivalent here, your APR is 2% if we did that. Now, that may or may not be right math. I'm just trying to show you, you're driving the APR down. So if you're still making 6, because your 6 is going up, remember it's compounding up, but you're paying this down and you're not changing your cash flow, you're not working harder, longer, or taking on any risk. Isn't this starting to sound pretty cool? You created a banking system where all you do in the future is make more. You use the money to do the things you would normally try to do in your life, but now you get paid to do it and you get to make the spread. This is the infinite banking concepts. But this also requires you to make some changes in your life, which is kind of what we're going to talk about today. We're going to talk about the need. We're going to talk about designing the tool. We're going to talk about using the tool all around this exact premise. Before I continue on, there's something really important, okay? So coming up this weekend, Thursday, Friday, Saturday, we've got an event that we're putting on. It's called the Blueprint, okay? We did one of these events already, and we've got another one coming up. Now, we're going to spend the next hour, let's say about next hour, explaining this concept that we just began. But this weekend, we are going to literally take a deep dive for 3 days, Thursday, Friday, Saturday, and we are going to dive into the full out advanced levels of infinite banking and a whole bunch of other things like trust planning, entity setups, and why you should have an entity, all sorts of stuff. Okay. And I'll have Stephen kind of tell you a little bit about that. But I wanted to just take a second and let you all know that this weekend, you need to devote a little bit of time. Now, I already said earlier, things are getting a little weird out there. Things are starting to not make sense. This is a time, and mark my words, folks, I'm not just saying this trying to sell you a ticket to this weekend's event. This is a time where you have to take action. If you're a deer frozen in headlights, guess what's going to happen? The car is going to hit your ass. That's what happens, right? Deer freeze in the road when they see the headlights, and they're like, ooh, pretty lights. And then it's all over. It's all over. Please don't be the deer frozen in headlights. You have to take action. You have to do something. You have to learn what the next steps are on how you're going to turn this negative situation, this declining economy, possibly a recession. A lot of words today thrown around on social media and also the news stations about recession because of this Iran war, because of gas price or oil prices and so on. So you need to get on the right side of this. And you need to get in a big hurry to get on the right side of this. So this weekend is a big hurry for you to get there Thursday, Friday, Saturday. Stephen, do you want to just say a couple words about it?
Yeah, Chris, it's this is one of my favorite events that we have ever done. We've been doing them since 2020, since the start of 2020 and COVID happened. We did them 3, 4, 5, 6 times a year for 4 years in a row and really fine-tuned them. And so over all of that time, over the past 5 years, helping thousands of clients, we've come to learn kind of who our client is and the best way that we can truly support and help them. And most importantly, help you kind of get the mindset that you need to be able to become your own banker, take back control of your money and truly solve your money problem. Because like the saying goes, you could take a multimillionaire, take away all their money, drop them in a city, and they can rebuild wealth very quickly. Why is that? Because they understand money, they understand how money moves, and they understand business. They understand how to eliminate things like wealth killers from their life. And conversely to that, and we see this happen all the time, you can take people and help them eliminate their debt. But what seems to happen with a lot of people several years later? They're right back in a lot of debt. Why? Because maybe somebody gave them money to pay off the debt. Maybe they did a debt consolidation and just wiped it out. They went through bankruptcy to wipe it out, whatever the case is, but they didn't solve the root problem, which was understanding money. And because of what we teach, Chris, with becoming your own banker, the infinite banking concept, real estate investing, both on the active and the passive side through Private Money Club, all these alternative investing strategies and techniques, self-directing your retirement dollar, because we teach so many different powerful strategies that are outside of the traditional way of looking like a financial advisor thinks, or like maybe you looked at money in like school or something like that. It's kind of like the complete opposite. And so what I've learned, Chris, and I know we talk a lot about this, but we understand our clients learn in different ways as well from different types of people. I mean, Chris, how many times have you had a client that was like, hey, I watched another IBC presentation. It didn't make any sense to me. I saw your presentation and it clicked like that. How many times have you heard that?
A lot.
Right? I mean, Craig, how many times have you heard, hey, I watched Chris's presentation, but then I saw you on a webinar and something you said, Craig, it clicked in me and all of a sudden it all made sense. I mean, we hear this stuff all day, every day, right? And so what we've done with this 3-day training is we've taken all this experience helping thousands of people all across the country take back control, and we put it into a very structured format starting from the very beginning. So this thing starts tomorrow morning at 10 a.m. Eastern. So first off, I apologize for the late notice. If you haven't heard about this 3-day virtual training yet, if this is the first time you're hearing about it, I apologize. It starts tomorrow morning. The good news is we do record the entire thing. So even if you can't make some of it tomorrow or Friday or Saturday, we're going to have the recordings. We're going to give those to you, and you're going to be able to go back and catch up on what you missed. But the important part is starting on day one tomorrow morning, because we start with mindset. And the mindset, arguably, again, is the most important part out of all of this. Because I can show and do this for any of you guys, but until you learn how to do it yourselves and actually take that control, it's not really going to make a massive change in you and your family's financial future. So we start tomorrow and all day tomorrow talking about mindset, the ways to look at money, how to leverage money, how to use other people's money. And then we go right into Friday, day 2, becoming your own bank. And that's what Chris just referred to, these advanced strategies, how infinite banking really works, how we're going to start moving the money, not just in the circle that Chris draws, but how to start expanding that circle into multiple circles and how those all come together. Okay. And so we're going to do that on day 2, and then going right into day 3. Now that we kind of understand, have the right mindset, we understand what we're doing. Day 3 on a Saturday is all about taking action, opportunities, being able to start growing wealth and really being able to take that control of your financial future. And so we've taken all of our experience, we've taken all the feedback from all of these events we've done in the past, we've taken all of our, listening to our clients and what they want and what they tell us, and we brought it all together during this 3 days. So we're bringing in our top money mentors on our team, people like Craig and Marius, people like HELOC Joe, people like Brian Fouts. We're going to bring them in to teach you the stuff. So you're not just hearing it from Chris's YouTube channel or from me. You guys are hearing this from our team of experts all across the country that have their own very unique ways of explaining and teaching you these very powerful strategies. So I'm super stoked for it, Chris. So go to that website right there. Now, Chris, I know you wanted to do something a little bit different for today. We've been selling these tickets now for a couple weeks. And by the way, guys, I say selling tickets, it's $97. All right. $97 for the VIP ticket. It gets you the recordings, the bonus sessions, the special digital gifts, gets you all this stuff. So make sure you take advantage of the VIP. If you're going to be there all 3 days, you don't care about the recordings, there is a GA option. It doesn't include the recordings for $47, but spend the extra $50, get the recordings, get the bonus sessions. Trust me, to be worth it tenfold. We also do 100% money back, no questions asked guarantee on this. So just shoot me or Chris an email after the 3-day. If you didn't find value, if you didn't like it, if you didn't think it was worth your time, just say, hey, Stephen, you guys are cool, but I'd rather get my money back. No questions asked. We'll send it right back to you. No problem at all. And so it's all right there for you. So you can go to the site right here, click right here, put in your credit card, and you'll get your seat ready to go tomorrow morning, 10 a.m. Eastern. We start on the dot. So don't be late. Again, if you can't make it right then, we do give you the recordings each night as well that are time stamped. But hop on there. But you guys can go to the website yourself, kind of look through here all day Thursday, all day Friday, all day Saturday. We do end up going a little bit later usually. So just kind of plan on maybe a little bit past 4 p.m. Eastern, especially with question and answer and things like that. But our whole team's going to be on there the whole time, answering all your questions, helping support you guys, taking phone calls and everything else. And so just to kind of, you can scroll down through here, check out who some of the different speakers are, who they are, what their topics are going to be. So there's a lot on the site, but more importantly, buy your tickets. So Chris, I think you said you had the first 2 people that buy from this webinar right now are going to get something, and then the rest are going to get something else. Is that right?
Yeah. So I always love giving stuff away. So back a while ago, I made these limited edition skateboard decks. Now I know you don't need to skateboard, but they do look pretty cool on the wall. These ones here, okay, once they're gone, they're gone. They're never going to come back. So for the first 2 people that buy tickets, I don't care if you buy a GA or a VIP, first 2, we're going to send you one of these decks, okay?
Can I buy one? Actually, can I buy a GA? I kind of want that deck.
I know it's pretty sick. Actually, these decks sell for $66.
Yeah,
and a GA ticket's $47. Yeah, Steven's going to be on there buying, yeah.
That was real dope, dude. I like that one a lot.
First 2 people get the deck. Now, anybody else, so if you're fast, someone's right now probably clicking, but anybody else is going to get what we're going to call a mystery box. But the mystery box requires us to know your size. So if you buy a ticket today, even if you think you're number 1 or number 2, give us your size, and do that by just putting it right in the chat. We'll save it. So if you buy a ticket, we'll just put your size of your shirt, and you're going to get a mystery box. We're not going to tell you what you're going to get, but you're going to get something really cool. We've kind of identified some really fun designs that we're going to send out. So everybody that buys a ticket today gets either, well, the first 2 get a deck. That's the best value. And then the rest of you get a mystery box that we're going to send to you just for buying your tickets. Now, that isn't the reason you should buy your tickets, but it definitely is a little sweetener on top. That's what I got for it, Stephen.
All right. I love it, man. Yeah, we won't harp on it, but buy a ticket, get there. It's life changing, full money back guarantee. And we stand behind everything we say, stand behind everything we ever talk about. And that's what this is all about. So if you're new to our community and Campfire, welcome. You guys are in the right place. And we look forward to working with you guys.
Perfect. All right. Well, let's talk now. Let me get back into it. And then I'm going to bring Craig into this. Actually, I got
Sorry,
to,
Chris, real fast. Just Ainsworth said in the Q&A, he said, got it. I joined the PMC as a result of the last one we did in January. Great info, and I look forward to signing up for this one also. So
yeah, this one's different too, just so you all know. This one will be very different. There might be a little overlap in a couple sections, but for the most part, we always do, even though it's the same name, Blueprint, it's a completely different training.
yeah, I did like, for example, I did the four wealth killers presentation, 60-minute presentation on the last one. This one, I'm going to talk about the economy and the markets. And so it's
Yep.
going to be completely different. I know Brian Fouts has a whole different presentation set up for this one. I know Noah is going to tell some different stories and set things up a little bit differently than he did on the last one. I know Carlson has a much different presentation. So yeah, right across the board, we're bringing Todd Billings in for the first time ever to our campfire. I mean, how much he's raised, what, 300 million or something, or
Yeah.
it's close to a billion. I don't know. It's
He had his own
ridiculous
family
amount of money.
office. Yeah. Yeah. And
Just unbelievable guy, though, and Todd Billings. And so he's one of our consultants and mentors, actually. And so we're bringing some new people in. I'm stoked for it, man. I'm excited.
it's going to be pretty awesome. And, getting back to the core topic of today with the infinite banking concept, one of the things you have to understand is the wealthy, the way they do things is just different. I think all of you know that. You can read books that teach you that, but the wealthy, they don't plan for tomorrow or next year. They plan for decades. Okay. And that's what the whole thing is you have to give up something to get ahead. And infinite banking 100% is a concept that rewards long-term thinkers. So people that are just looking to make a quick buck, people that just want to make, get rich quick, this is not for you. So I'm sorry, if you came on here thinking, oh, I'm going to get rich quick with this. Unfortunately, I just don't want to set false, expectations. This is not a get rich quick, thing. This is a stay wealthy long program. This concept will not make you rich tomorrow. It certainly will help you get off to a much faster start because of uninterrupted compounding interest and allowing you to control and recapture all the money you're giving away. But unfortunately, it is not for those who want a quick get rich scheme. Okay. Most
Yeah.
of those people lose the money anyway.
And Chris, just can I add to that real fast? So the last couple of nights I've been doing these kind of like little preview webinars talking about the 3 day. And something I've been saying is, who is our ideal client? Like, who is our customer? Who is this right for? And one thing I did make very clear, it's not for somebody that's broke. And I wanted to, and I've kind of clarified that a little bit. And I want to see if you agree with me on this. So what I mean by broke is to me, being broke is a mindset. Now, you can be struggling financially, you can be living paycheck to paycheck and feel broke, but it's all about what you're actually doing with your money. Because, Craig, you work with a lot of people on debt, right? You've created the Debt Blaster and the BYOB Vault and all these ways to help people with Vault. How many people do you talk to on a weekly basis, would you say, that think that they're dead broke, but it's more a cash flow issue? And then when you show them, hey, let me take, what I mean by broke is they have no money at the end of the month. All the money's going to credit card bills or other bills or whatever. But what you can do, Craig, is you can take where their money goes first, put in this policy, then use one of your debt pay down strategies to be able to start changing the way that money flows to allow them to clear up some of that debt that then does provide them cash flow without making any additional income. Is that right?
That is correct. And what's interesting is after talking to hundreds of people and running numbers through the vault, there's some patterns, and I'm going to talk about those in the 3 day as well. Some of these patterns I'm seeing, but that's exactly it. One of the big patterns is people have resources, they're just not putting them in the right place. And so the other thing I've seen too, Stephen, is and it happens so many times where people say, "Yeah, I've got maybe $1,500 left at the end of the month." And I ask them, "Where's it going?" And they say, "I don't know." Like, well, do you have 1,500 at the end of the month? And so, the other piece of this is people have resources, they don't know where they're going. There's a lot of money leaking out of their economies, their personal economies, and they just aren't sure. So a lot of times when we have these conversations, we get clarity around what does your personal economy look like? Where's your money going? How can we reposition it to make your situation better? But absolutely. That's what we're seeing.
Yeah, I love it. And so that's why I always want to clarify, like you might feel broke financially, but as long as you don't have a broke mindset, meaning you have an open mind, you're willing to learn something new and you're ready to apply that and take action, we can help you. Okay. So I just want to make that very, very clear. But really our ideal client is somebody that's making good money. That's maybe has a decent retirement setup. Maybe they're a little worried though that another '08 is going to happen and their retirement accounts are going to drastically drop, or they just feel like, hey, I'm making two, three, four, $500,000 a year, but I'm getting killed by taxes. I'm getting killed by all these different fees I pay to these advisors and all these different people. And you still feel like at the end of the month, there's just not as much there as you know there should be. Well, that's what this 3 day is all about. It's eliminating those wealth killers and how without working any harder, any longer, taking on any more risk, just making one change where the money goes first and having to open mind these new strategies, it can make all the difference in the world. So I just wanted to bring that up. I did see one question. Tommy said, what about if you have questions after the recordings, after the 3 day event?
Oh,
And that's a
good
great
one.
question, Tommy. So Chris, do you want to hit that?
Well, no, go ahead. You're
Yeah,
on
I
a
mean,
roll.
so we have a full support staff and team. So we employ an entire group of individuals. They are all Nelson Nash Institute certified practitioners, meaning they understand the infinite banking concept better than anyone in the country. They're all personally trained by Chris, myself, and we make our team read books every single month. We make them attend trainings and go to these different events so they can constantly be learning on what's going on. So they're there for you. Our money mentor team is there for you anytime you need. You can schedule a call with your money mentor. We're right there with you on the wealth growth side, on the investment side, private money club I'm talking about here. We have an entire blueprint success team over there as well that's there to help support you. And then, of course, we do 6 live webinars every single week. You can hop on, get all your questions answered. And we do live in-person events throughout the year. We got another one coming up in Atlanta, May 1st and 2nd. So come out to one of those, meet people in person. But the best part I love about our community, other than our team, are our clients and our people, because I can't tell you how many of our clients end up partnering together, end up becoming friends and just having conversations together. I mean, how many of our clients, Chris, have told us that they have accountability meetings like once or twice a week with each other in the mornings, and they just talk through things. So I love, and on our events, all of our events, webinars, we encourage networking. Like out, like other companies are like, I don't want you guys talking to each other, I want you only talking. No, we want you to help each other, we want you to talk to each other. So we encourage all that networking. And so that's what I love about it, is just watching those clients and customers end up helping each other, which is just super cool for it. So yeah, Tommy D, we are there for you, my man.
Yeah, and let me kind of kick it into high gear here as I bring Craig on to kind of show you this is, how many of you would be willing to give something up today if you knew that you were going to gain for the rest of your life? In other words, how many of you would give up, I don't know, 2% return on your investments to gain for the rest of your life without any variance or any, volatility in that? I'm probably not saying this the right way, but one of the things you got to look at is, again, this is a long-term process, a long-term concept. So when you get into the infinite banking concept, in the beginning, and I'll speak for myself, when I first started, it feels slow. Like the first quarter felt really slow because I was anxious. I wanted to get off to a fast start. I wanted to get this money working for me. And then the next quarter, so 2 quarters in, still felt slow. But then after that, I started developing habits and patterns. And then after that, it started going faster and faster. And as we get into this next part, we're going to get into some case studies, and you're going to see what we're talking about of what the give is, like what are you willing to give up to gain for the rest of your life? And really it comes down to, are you willing to give up a little bit of return to get a return for the rest of your life guaranteed? And I don't think I've ever met anybody in my life that said, no, I wouldn't give something up to get for the rest of my life. And that's exactly what this is. And that's the beauty of compounding interest. And that's why Albert Einstein said, it's the 8th wonder of the world, he called it. And he said it was the most powerful thing in the financial universe. He's talking about compound interest. And it truly is, because it never stops. And just to be clear, outside of maybe a big brokerage account with a margin account, the whole life policy, is one of the only vehicles on earth that you can put money into it, and that money will continue in your account to earn for the rest of your life until the day you die. So even, and what I mean by that, even if you take the money out, it never gets interrupted, which I know it's hard for a lot of people to kind of comprehend how vital that is or how amazing that is. but it really is. And, I think the best way to sum this up is how many of you have ever looked at bamboo? Like, the weed, bamboo. Do you all realize how bamboo operates? Bamboo, if you were to go to the store and buy those like little bamboo stalks and you were to plant them or just get a seed, a bamboo seed and plant it, you will think it died. You will think nothing happened. It literally takes 5 years, 5 years of growing underground before it breaks through the soil. Just think about that. It's kind of like the iceberg. You always see that, right? You see a little bit on the top, but then what's underneath the water is the really magnificent part. It's the same thing. Underneath the ground, for 5 years, the bamboo is setting the foundation, setting its roots, getting itself ready for a massive explosive growth. And then once it breaks through, it can shoot up 90 feet in weeks. 90 feet in weeks. But it took 5 years to set itself up, to create its foundation, to make it so that it was strong enough to support the weight of massive growth. Folks, that is exactly what we're going to show you today. And that is exactly what the infinite banking concept is. Craig, I know you have some slides on this. Let me just turn it over to you, and then we'll kind of riff back and forth in this next section.
Yeah, let's do that. And as you were talking, I was thinking about the long-term nature of what we talk about with the infinite banking. And for those folks that say, "Hey, I want to wait 3, 4 years for this thing to get efficient," there's really no way to lose for you and your family because here's the way I look at it. If it takes you 3 years to get efficient and you don't live 3 years, your family just got a large multiplication of your money. But if you live anyway, then that efficiency in the first few years didn't matter anyway, did it? Because now you're at that efficiency point and you have the compounding machine going. So whether you make it, whether you live past that short-term efficiency period or not, your family is going to get multiplied money. So I was just kind of thinking about the that first few years of that inefficiency period. But anyway, let's talk more about that. Yeah, and what Chris was talking about earlier is I don't know if you've heard the parable of the bamboo, but there's a whole story around it of this farmer that was growing this bamboo. I don't know why anyone would want to grow this bamboo, but they were. Um, and he was kind of ridiculed because he was going out and watering this thing every day. And I'm sure your family, your friends, your people that don't understand infinite banking would probably come and laugh at you like, "Oh, you're dumping that much money into those stupid whole life policies? What's wrong with you?" And so it's no different than the parable of the bamboo where we're watering this soil and there's nothing there and people are looking at this guy like, "What is wrong with you?" However, there's a point in time and that bamboo after that 5 years pops through the ground. And like Chris said, it shoots up exponentially. So how do we really look at this in comparison to what we're talking about on the infinite banking concept process is, yes, it takes years to grow and to build, but I do want to make something very clear here because this is something I hear frequently is people will come to strategy calls when we're talking to them and they'll say, "Oh, I've heard Chris, it takes 3 to 5 years before we can even get money out of this policy, right?"
Yeah, not true. Not true at all.
And that is not true at
30
all.
days, immediately in the first 30 days.
Mhm. So we're building these policies in a way where you can get access to some of the money within the first 30 days. So that's a myth. We can bust it. You don't have to wait 3 to 5 years to get your money out of the policies, but it does take some time for it to spin up. So when you think about everything we're doing, and I think Paul, I don't know if it's Paul or who it was saying earlier about there's typically very little validity in these get rich quick schemes, and this is not a get rich quick scheme. It's a keep your wealth for the rest of your life and keep growing it from generation to generation. That's what this plan is all about. But let's dig into it a little bit more. Out of today's session, go get this book, download it on Amazon, go buy the paper book, whatever you want, listen to it in audio. It's a short book, but listen to this book. It's kind of the foundational story of everything we're talking about here. But R. Nelson Nash, he's the one that codified this whole infinite banking concept process. And some of the things that he's well known for is telling people you have to think long range and just this whole art of thinking. And Stephen, I remember a while ago, I don't know if it was Mark Twain or somebody, you had a quote that you put up about 5% of the people think they think, and I don't know if you have that available, but it was kind of a fun quote of, and then like 80% of the people don't want to think. But there's thinking involved in this process, and it also involves thinking long range. But that's a lot of what Nelson Nash would teach. And I just pulled out some other concepts and questions about, and maybe just, you can chime in the audience too, but if conventional wisdom was correct about how we do our money, wouldn't the population be in a better financial position than we are? I mean, I hear a lot of people that have challenges with debts or, with the rise in expenses and inflation, everything's just really hard. But do you think if conventional money wisdom was right, we'd all be in better shape? And we're not. So there's got to be some fragment of information. They're like, well, maybe we should do something different. And we should think about controlling that banking function in our life. And that's really what we're talking about today is controlling the banking function in our life.
Hey, Craig, real quick, there's something that just came to me.
Okay.
You're talking about like making the change. We just made a big change, folks, and this is something near and dear. So I wanted to mention this because it's perfect timing for this. Somebody just a second ago, and sorry, I don't remember the name, might have been D, had asked, hey, is there somebody I can jump on a call with? I have some questions, and if it's D, I'm just going to pick on D here. She very, very familiar with IBC, just had some additional questions. So one of the things I hate, I absolutely despise it, is kind of where we've gone to from a customer service standpoint, just in almost any industry. When you want to get somebody on a call because you want to ask a question or you want to see if, this infinite banking can solve a problem, then you would call somebody and you would get a voice recording or you'd get bounced to a AI agent. Like how many of you love talking to AI? I mean, any of you love when you call a company and all of a sudden you're talking to AI? That works out really well every time, doesn't it? It's awful. It's terrible. It's the worst thing ever. So we eliminated all that here. When somebody wants to talk to somebody, just like Dee just did, you just give us your number. Okay. You send over your number, give it to us in the chat, in the Q&A, send it to us privately, however you want to do it. And we'll have somebody call you right now. That's how we're doing it from here on out. And that's going to get better because eventually we're just going to have an 800 number. You just call and there's somebody standing by to talk to you. Not infomercial wise, because we're not there just to, talk, you're not calling just because, hey, I want to buy that widget. You want to actually solve your problem and you want to talk to a human being about your problems, your situation, and can this help put me in a better place? Well, we have that for you. So if any of you want to get on the phone with one of our money mentors, all you need to do is give us your name, your email, your phone number, and somebody will call you. Now, I know we're in the middle of a webinar, so you're probably like, well, hold on, after the webinar. So here's what we'll do. If you give us your name, number, email, we'll have them text you and say, hey, when would you like to jump on a call? D would probably be like, oh, right now, I know what this stuff is. I just have questions. So I want to put that out there and make sure that all of you know that we will always have a human for you to talk to. It's silly that I got to say a human for you to talk to, but those are the times we live in. And we will absolutely solve your problem. So sorry, Craig, didn't mean to jump in there, but.
No, I think it's
sorry, our team already called D too. So they just left you a voicemail, D. So we're ready to go for you.
awesome. Yeah, I mean it's really important. All the things we talk about. I mean, I saw a comment earlier, and I don't remember who it was, but they said I've got some questions, but I don't really want to put them out here in the open. So that's a perfect case for if you have some questions, you don't want to put it in the post. Maybe it's about some debt situation or something else that's going on. We can jump on a call with you and talk about that. So that's a perfect use case. And a lot of the stuff we're talking about now, just so far is mindset. And just remember in the 3-day blueprint that we have coming up, the pretty much the first day is all about mindset because we have to rethink our thinking and how money works. And we have to learn a new way of money works. So a lot of these things that we're sharing now are going to be deeper and reiterated on the 3 days. So hopefully everyone can make that. But what I want to do is go through some use cases And just kind of, I know we have a lot of new folks here, so please ask questions if we're covering something and it doesn't jive or doesn't make sense. But in these use cases, I like to just tell you all the ingredients of what we're doing in terms of the designs that we're working with here. So let's just assume we have a 50-year-old male. That person's making about 150,000 of salary a year, and we're going to have these different ingredients inside of the policy, which we'll cover some of the what is purchase, paid up additions with dividends, what does all that stuff mean? So I'm just kind of listing out what are some of the things we're doing in our design. Now, before we jump into the design of the product or the policy, we want to talk about some concepts. When you're working with mutually owned insurance companies, who we do, there's some things we need to consider when we're building these policies, and one of them is called the human life value. And so think about insurance. Even though we're using it as a tool for our banking system, insurance companies are looking at this tool as a way to replace economic loss. So if I'm insured, something happens to me, the death benefit goes to my family, my income's protected. And so one of the things they look at is what is the human life value of that person? And I have to make it very clear, it isn't because of your life is more important than another person's or less important. They're just simply trying to say what is the economic value of that person's income that needs to be replaced. So the higher the income, the more it needs to be replaced. So that means we can build bigger policies. So a lot of times we have questions, and Stephen and Chris, I'm sure you hear it all the time too, like how much do I have to put in or how much can I put in? There's different reasons people ask those
All the time.
questions. Yep. And so these are some of the guidelines that would tell us how much you can put in.
Dude, the other day, like at that mastermind, I gotta say this, it
Yep.
threw me for a loop. They're like, well, how much does it cost? And I'm like, what? Well, yeah, I mean, like, how much does it cost? Like, how much do I got to put into this thing? I'm like, you're, I almost didn't even want to talk to him. It's kind of like, you're looking at this totally wrong. And then I reframed it and I just said, you mean, how much do you want to save? How much money do you want to save for your future, for your goals? Oh, yeah, that's what I mean. Well, I said, and I stopped him. I said, but that's totally different. How much does it cost and how much do you want to save are two totally different things.
Yeah.
So you
It
got to
really
get your
is.
mindset around the saver, right? Not the spender, the saver, because that's who we work with.
And I'm going to say something, it doesn't mean that we can put all of our income in, but the question, the way I kind of look at this is if you could keep of all the money you make every month or every year, how much of that would you like to keep? And most people will say, well, I'd like to keep all of it. Well, we're not going to be able to keep all of it, but that gets us thinking differently in terms of, well, how much does this cost versus how much do I get to keep? And that's really the conversation we need to have as we're designing out the system. But why does your income matter? Why does your age matter? Why do all those things matter? Because those are guidelines on how we can fund these policies, and it tells us how much we could cap out at. It doesn't mean we have to cap out. But let's go back to the person that's 50 years old with an income of 150,000. A example human life calculation would be 20 times your gross income. So I could take 20 times 150,000, and that would mean I could have up to $3 million of death benefit on my body. So because I make 150, the insurance companies are saying, well, you probably have 20 more years of working. So if something happens to you in those 20 years, we want to replace that $3 million of income for your family. So that's what this means. Now, the other piece of it is, so Chris, if you're the insurance company and I make 150, are you going to be okay with me putting in 150,000 of income into my
Nope.
policy?
They
Why
will
not?
not allow you to do that.
Why wouldn't they though?
Well, because they know you probably have living expenses and they know they just know that you should not put 100% of your income into the policies.
It probably wouldn't be sustainable, would it?
No,
And who loses if I start a policy and cancel it in the first couple of years?
the insurance company loses huge.
Who else loses?
The client,
Who else loses?
we, the agents.
You're telling me everybody loses if this thing doesn't keep going?
Yep.
All right. Well, that's why we talk about these income to premium ratios. So if you're making 150,000, the insurance company may say, well, we'll let you do up to 25% of that gross income in premiums. We don't want to really go above that. There are some exceptions, but hopefully this helps build the guidelines on how much we can put in. And if that doesn't make sense, please let me know. But we get this question a lot. That's why I wanted to cover it in today's session. So just think of we have a maximum death benefit and we have a maximum amount of premium that we can put in, all based on our age and our incomes. Now, let's go talk about policy designs. And Chris, is there kind of a one size fits all policy design that we do?
Boy, that would sure make our lives really easy, wouldn't it? No, it's not. Every policy design is custom built for that client's needs and goals. And we have models that we will use, but the models do not mean that the policy designs are the same. They're just a reference point based on someone wanting to pay off debt. What are the most efficient models we can use to design the policy? Somebody wants to invest in real estate. Somebody wants to start a policy on their child to save for their college. Like all three of those models are completely different, but each one is designed for maximum efficiency in that use.
Yeah. So we have some different levers we can turn on and dials we can turn to make the policy do what we want it to do. And when you when you talk about this to other folks, you might even go down the street to your State Farm representatives. Hey, I want one of those whole life policies I can use for infinite banking. They probably don't really understand what's going on with this whole policy setup and how we're trying to use it. They might know some of the verbiage. The first question I would always ask, and for anyone booking a call, always ask, whether it's with our team or someone else, hey, let's say I book a call with Steven. I might say, hey, Steven, how are you using your infinite banking system? What do you do? How does this work for you? Because ultimately, if your answer is, well, I've heard about it, I haven't really done it myself yet, you're probably going to come up with some sort of rubber stamp policy design. And we got this funny little picture with a little kid with the oversized suit. And if we were selling suits and everybody got, a 42 long, well, there'd be some funny looking, clothing walking around. So it's very, very important that we have this strategy call. We understand your goals. You get your questions answered. We understand what you're trying to accomplish. You're paying down debt. You want to build an opportunity fund. You want to get your kids to college. All of those things will drive how we design these policies. The real meat of this is there are design considerations. There's ingredients in these policies. All of these things we consider: age, health. What's the solution we're working towards? When do you want to take a loan? How much by when? And then are you doing a dump in? And I'm sure when I say dump in, there's a lot of folks here that know what a dump in is, but Stephen or Chris, do you want to chat about what a dump in is and kind of why we do those?
Well, it's not what you do on a toilet. I can start with that. So a dump in is
Oh
simple. It's
boy.
basically taking money that you may have saved. Usually, typically, what we see is people save money in a savings or a checking account. They got the money sitting there. So what you're going to do is you're going to take it out of the bank, or I always like to say, I'm going to take it out of my right pocket and I'm going to dump it into my left pocket. My left pocket being the specially designed whole life, right pocket being the traditional bank. The reason I'm doing that is that supercharges the policy right out of the gate. Because if you think about it, like if we were to dump the money from your bank account into the policy, how much is your bank account paying you on interest? It's probably nowhere near what the insurance policy will pay you. So if the insurance policy has a dividend crediting rate of 5.9 to 6.6%, isn't that better than what you're getting at the bank? Some of you might be like, well, it's close. It's not close because you're earning that tax-free versus a taxed, place like a bank account. So you're just dumping money in one time, or we can do it numerous times. And all it does is kicks the policy off to a really fast start.
So it's a way to capture those dollars, and we sometimes see that where people say, "Hey, I've got this money sitting in my savings account. Should I just go pay my debt off?" Well, what if we put that into the policy first so it compounds and grows the rest of your life, then leverage some of it to pay the debt? So there's a lot of different opportunities where we can get those big chunks in, maybe one time, chunk into the policy for those purposes. So the whole story here, there's a lot of ingredients. We're going to understand what you're trying to accomplish, what your particular situation is, and then build around that. And so there's just all these different considerations that we're going to make. Now, Jalen asked a good question in the chat. What if I have multiple goals? What if I want to pay my debt down and I want to do real estate and I have multiple things I'm trying to do? Let's definitely look at all that and figure out how we can build that in. Could it work with one policy? Do we do multiple policies? Maybe. So that it's a really good question that it's going to require a conversation. Man, it can be done with one, it can be done with multiple. So we have some options there. Chris showed a video at the start of this wealth webinar, and Chris, I don't know if you want to post that in the chat just so
Yeah.
people can go back, but I want to just do a quick flyby of very similar conversation of what Chris was going over in that video. Let's assume that we have this 50-year-old male where we put in $10,000 of premium every year. We're not doing dump-ins, so just think of every year we're going to put $10,000 of premium in, year two, 10,000, year three, 10,000. And we can see that in this premium column that we're putting in 10,000 up to about year 10. And what we're doing in this design consideration, let's say that we're doing a debt pay down. I put in $10,000 by the end of year one. I can potentially do $7,685 of cash value. That's what I have available to pull out. Now, this is where we talk about the bamboo. Remember how the bamboo's under the ground growing for the first 5 years before it pops out. This bamboo, this policy, if we're, treating it as the bamboo, let's say by year four, year three or four, and this can be done in year two, it could be done in year 4 or 5. It all depends on the policy design. But in this particular design, we have what's called cash on cash being positive at year two. What that means is that if by year four, because of all the previous years of compounding, when we put that $10,000 of premium in, we have $10,202 of cash value. Are we now getting more out in terms of growth on a year by year basis? Yes, by about 2%. That's not maybe all that exciting, but we're giving up something in the early years to get something much bigger in the later years. So we start to see this cash on cash just continue to go up and up and up and up. Now, if I take a loan, let's say I take a loan at year three for 20,000, how much does that impact this cash on cash growth? So absolutely, it doesn't impact it at all. So whether we're taking a loan or not, this money is going to continue to grow and compound. That's really important to realize. And yes, Michael brings up a point of non-direct. There are some companies and policies where that wouldn't be true. What most of the companies we work with, this is true. So that is a distinction we need to make. But anyway, this is an example of a policy, what it would look like. We get down to year 10, we've put in 100,000, we have 111,000, so we're, 11% cumulative return on that. We're on a cash on cash, we're at 41%. So this is just the product, but we haven't talked about what we're doing with that. Could we potentially pay down debts with this? Could we use this money to invest? Could we use this to, capitalize to buy a car? Yes, on all of those. And so we get into the next step, which is how do we actually use these policies? And this is just another example where we're doing a $25,000 dump in. So think of I have 25,000 sitting in my savings. I dump it into the policy, but then I also am going to do this 10,000 annual. And so this is just showing you it brought the cash on cash up a little bit. But anyway, it just gives me more access to capital faster because if I put that $25,000 of a dump in, I can have access to about 90% of that within the first 30 days. Very liquid. And so I'm able to get access to that money for my debts, for my investing, for my car purchases, whatever it's going to be. So those are some of the things that we talk about just in the design phase. Chris, anything you want to add to that? Otherwise, I'm going to go ahead and move on here.
No, I think you can move on.
Okay.
But the only thing I just want to make, notice of is the difference between the dump in and not putting a dump in, and, in the early growth of the policy makes a huge difference.
Mm-hmm. Yep. So this one is not the dump in. We have cash on cash at year 4.
and this question came in, who just has 25,000 to dump in? So we have people that dump in like $2,000 or $5,000. It's all over the board. We have people that dump in millions. So
Mhm.
really, for the person that said that, there is no norm. There's only your norm. And when we design the policies, we design them around your needs and goals. So this is just an example. And would I say it's the norm? No, not at all. I would just say it is the norm for people to dump money in any denomination.
Yeah, and there's some that don't have any dump ins. Sometimes it's $350 a month, sometimes 500 a month, sometimes 10,000 a month, just all over the place. It's just
Yeah,
all over the place.
exactly. And Tommy, for what you're saying, you wrap your head around, that you need $1,000 a month. So let's see, wrap my head around that I need 1,000 a month to pay the mortgage, but if I borrow from the policy, I now need $1,000 a month to pay that back. So I think you're missing something, Tommy, and I'm not really unpacking fully what you're saying. But you're not, when you set this up, okay, I want to be very clear about this. When you build your private banking system, you are not adding to your current, like if today you bring in $5,000 a month and you save $1,000 a month, okay, hypothetical, that's the same equation here. We're just redirecting existing dollars that you save or spend, I guess you would say. But really just the savings is what we're repositioning. You are not working harder, longer, or taking any additional risks. So in your example, you're thinking of it like I need this much to do this, and then I got to repay it. No, 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 no. False. Completely wrong. Your saving is exactly the same. We build the policy around what amount you want to save. Then the recaptured amount. So in this example, I think you're using your mortgage. If we were to pay your mortgage off, the 1,000 you used to pay to Bank XYZ mortgage company is the same $1,000 you would put back in your policy because you became the bank. You take over for your current mortgage company and you become the bank holding the mortgage. And the same payment goes back to you, but then you're keeping all the interest. You're keeping all the money that would have been given away to the mortgage company. I don't think that's a good example to use a mortgage company or a mortgage, but I'm just trying to use your context here. So again, we have lots of other videos. We might not get there with you today. More than happy to have you jump on a call if you want to help walk through and explain it. But yeah, don't think that any of the dollar amounts we're using or Craig is showing are your dollar amounts. These are just examples. Your dollar amounts are exactly the amount you save and the exactly amount, whatever you're doing with the money if you're paying debt off.
And Randy had asked to show the no dump ins, so here it is. I don't know if you had a specific question, Randy, or if this is all you needed. But I wanted to dive in deeper on what Tommy's asking about because we've talked about the policy design and getting that all right. But then the next question is, well, how do we actually use it? And so let's just talk about, in Tommy's case, asking about debt payments. It could be a mortgage, could be credit cards, student loans, car loans. So inside of the system we call the vault, this is where we model, stress test, and validate that our numbers are going to work. Let's just say that this was your debt profile. You had some credit cards, you had some personal loans, medical debt, and so you have about $78,000 of debt, and you're paying $1,265 a month on those debts. Now, what most people do in their debt pay downs is when, let's say this personal credit card gets paid off, that $2,500 balance is now paid. That $75 just gets absorbed into going out to eat more, into the operational budget. It's not used to help accelerate other debts. So I'm sure a lot of you out here have heard Dave Ramsey talk about the snowball. There's avalanche, cash flow index. There's all these different sequencing methodologies used where snowball looks at the lowest balance to the highest balance. The avalanche looks at the highest interest rate to the lowest, and then cash flow index uses a sufficiency score. But the idea is if you just simply, when you pay a debt off, if you just take that payment, roll it on to the next, and just keep doing that, you're going to be more efficient in your debt pay down. And we can show that mathematically of if you did nothing strategically in your debts, you did no strategy, it would take 181 months to pay that debt off and about $30,000 extra in interest. So you're paying over $108,000 on that debt. If you just do the avalanche or the snowball or the cash flow index, You are building efficiencies in your debt because now that debt's gone in 80 months and your interest paid was down to 22,000. Now, I want you to remember back, Steven said something at the beginning of the webinar, and he said, and all the people we're talking to, we can help them get out of debt, but in 3 or 4 years, guess what? They're back in debt again. How do we stop that cycle? The way we stop that cycle is we can show you how to be efficient to get out of debt, but what if we could show you how to build wealth so that you wouldn't have to go to Visa, Amex, the different credit cards, so you could use your own system to finance the things you need and want? That's what we're talking about today is if we use that exact same policy, remember that $10,000 annual premium that we were putting into that policy? Let's just say that we're doing that every year. Now what we're going to do is I'm going to take a loan out once a year because I'm going to fund my policy. 30 days later, I'm going to take the maximum out and I'm going to throw that at my debts. So it's very similar to velocity banking if you're familiar with that, where we're using a line of credit, taking a chunk, throwing at the debts, filling it back up. In this case, we're going to take our $10,000 savings, put it into our policy, take a loan, and throw it at the debts. And to answer Tommy's question earlier, I'm not paying my loan back until these debts are gone. So I'm going to use my savings. I'm going to leverage my savings to accelerate my debt pay down. So the way we do that is we activate this cash value boost. Now, what's happening is we show these strategies of doing nothing differently with your debt than you typically do, doing the avalanche, or doing the infinite banking. Now, because we're leveraging our savings and it's compounding and growing, we haven't stopped the interrupting compounding or the compounding. We're getting rid of our debts in 47 months instead of 181 or 80. But Tommy, this is where we then say if we were paying 1,265 to Visa, the student loans, the car loans, why not take that same 1,265 and just start paying it back into our policy to reduce that loan balance and increase our cash value that's available to take again? That's all we're doing for the next 31 months. We're just paying back the policy the same amount. But there's a very important distinction that happened between this month 47 and this next stage because all of those debts have now been refinanced into my own banking system where I control them. I can pay them whenever I want, as fast as I want, as slow as I want. So say you lose the job, well, you don't have to pay this back next month. Maybe you skip that 1265 for a month or two while you get back on your feet, and then you pick back up at it. But this is the point earlier when Stephen was saying, hey, if you just get out of debt and you don't do anything differently, you're probably going to be in debt again. So in 78 months, we've got all the debts gone. We've got our policy restored. We put that all back together. Look at that. You built $64,000 of cash value and you have a death benefit down here of 247. So what's going to happen next time you need to borrow money for a car? Well, you go for your own system. What if you have a medical emergency and need $5,000? You pull it from your system and then you pay it back when you can. So that's the strategy in terms of a debt pay down. And Tommy or anyone else out there, does that help? Are there any questions on how the money's flowing here? Because I would much rather get my debts paid off in 78 months and have 64,000 than pay them off in 80 months and have nothing. That's all we're doing is talking about leveraging that savings amount. All right.
Yeah, Wendy
So
was asking about retirement because she's like, like talking about taxes, right? If you put money in a 401k or any qualified retirement plan, when you take that money out at retirement, you're taxed, unless it's a Roth, you're taxed on 100% of your distributions. And then she was just saying, can I just use the policy for retirement, and how does that work? So Wendy, we created an unbelievable video. I've got many videos on this, but I did one in particular. I'm looking for it here, but Craig, I know you kind of had that one unlocked, the volatility buffer one. So I'm going to find that video for you, Wendy, and I'm going to post it and I'm going to put it up for everybody else, but please watch that video. If any of you have interest in how can I use the policy and the infinite banking in my retirement strategy, it's way more than what you think. It's not just put money in the policy, take income from the policy. The policy works with an entire system to reduce volatility in your retirement plan. So
there
there
it
you go.
is.
I knew we had it unlocked. Watch that video and you should have a big aha moment. That was, I think, in my opinion, one of the best videos we ever made.
I would agree. I get excited when that one came up because it's just the strategy of think about what we just showed in that
Oh,
debt pay down, right? I used the policy to pay down the debts, recapitalized, used to buy a car, did other things with it. But let's say by the time I'm, 70, this policy could have up to $200,000 of cash value. And then you watch that video that I just posted that Chris is talking about, and this becomes supplemental retirement income, a volatility buffer. Market's down, I take from my policy. So it's a really cool strategy. The other good thing about using the policies for retirement income is you don't have that thing IRMA. If you don't know what IRMA is, check that out. But your income, all your income that you have that's taxable that comes into you at retirement, that's going to make your medical payments higher. You're going to have potentially higher Social Security taxes. So money coming from the policies, that's out of the picture. That's not considered. That's not part of the IRMA calculations. But anyway, we kind of digress, but it's really powerful stuff. So Chris, I know we're about at time. Do we have time for one more example, or do you want to kind of go into wrap up mode here?
no, we have time. And like I said, as we kind of come to the end, for those of you that are still on here, if you wanted to book, not book a call, but if you want to talk to one of the mentors, you just got questions, people like Tommy are like, oh, now I see it. Like, how would this look? If you just want to kind of sit down and talk with one of us and hear how this could help you, work for you, whatever, then just give us your name and your number. You could just put it in the chat, put it up there in the Q&A. And then what we will do is we'll shoot you a text saying, hey, when would you like to do a call? And just text us back, or right there, Stephen just put it up. You can just click that link and you can just pick a time if you don't want to do the call today. But for any of you that are like, I want to get on the call right now with somebody while this is, top of mind, or maybe you've already just blocked the time off and you're like, well, I have time right now, then give us your number and we will give you a call. Like
All
Emmanuel, you
right.
gave us your name, but we need your number. So there we go. We got, Wendy did that. It's just like that. And then what we'll do is we'll reach out to you. All right, Craig, let's do it.
So we'll go over one more thing, one more use case. And the question I have for everybody, do we have any investors on the call day? Are you doing private lending? Are you doing real estate? Do you have your own business where you invest your own capital? Okay, so here's kind of the other strategy is let's say that you started in debt and we got you out of debt. And as we're showing here, there's 64,000 available in cash value. You could use that for your investments. You could use that for private lending, for real estate, for your business. And one of the things we can show is you can kind of model that out inside of this thing called the gain projector. So think of it this way. I might have a HELOC. I might have a first lien HELOC. I might have policies and cash value. I might have cash. You can come in and pick your funding sources. And so let me just grab that same policy we had with the $25,000 dump in and the 10,000 a year. Let's just use that as our example. If you had a line of credit, you could also add some money from your line of credit in here. So think of HELOCs, think of first lien HELOCs, and then you might have some cash you want to throw into the picture. But what this is all about is how can we take let's just grab 20,000. I'm gonna grab 20,000 out of this policy and put it to work. Now, isn't it true that the policy is going to compound and grow regardless of whether I'm leveraging it or not? So why not take some of that and put it to work? Maybe we leave a buffer in there for emergency fund. But if I take $20,000, I can come down and now say, I want to plan an investment. Maybe it's a private money club opportunity where I'm, putting $20,000 in for 12% or 15%. So you can kind of model your investments out. I'm going to kind of run in an easier mode where I'm just simply saying, I'm expecting my investment rate to be 12%. So we're going to take $20,000 out of our policy, put it into an opportunity that gives me 12% annualized return. Now, the question is, what do we do with our policy loan? Do we pay it back? Do we not pay it back? Do we take all of the gains and run that back into the policy, let it recapitalize, build it up, and then take more? Do we just take enough of the gains to pay the policy loan interest and keep the money out working? Well, guess what? There's no one size fits all. It depends on how your personal economy is working, how your investments are working. But guess what? We can model that. We can say, I don't want to pay any of my loans back. Or maybe I want to pay the interest only from the gains. Or maybe I just want to run everything back into the policy. So with a click of a button, you can kind of model these different scenarios out and figure out what do you want your specific situation to look like. Now there's some simple views here. Chris likes the quick buttons just to show me kind of what's going on by year three, where, this is the bamboo tree. The bamboo's still in the ground year one, the bamboo tree is still in the ground year two, but by year three, the bamboo tree is now shooting through the ground. And from this point forward, our cumulative return, our net benefit just continues to grow and grow and grow. So you can kind of see things in this view. What I like to do is go down to this presentation level,
I love this.
and it'll just show you how. And if you download this as a presentation, if you're a PowerPoint fan, you can run this in an automation. So it's going to show you taking the money from your bank account, running it into the policy, taking your $20,000 loan. Now, when we take that $20,000 loan, it's going to end up in our segregated bank account because the insurance company is going to have us link a bank account when we take loans. Then we're going to, from that bank account, we're going to deploy our capital. So let's say we put this into a private lending opportunity. And guess what? If you come to the 3-day, you're going to hear about these types of things on was it Saturday, Stephen? Saturday? Yeah. On Saturday, we'll be talking about different folks teaching you how to do this, whether you're buying notes, private lending, there's all sorts of really cool opportunities. But if we're making 12%, we're then going to have 2,400 of gains coming back. And in the model I'm running, I just said, hey, of that 2,400, take enough, pay my loan principal and the rest of it. When I get to year two, I'm just going to add that into my investment gain. Plus, I'm going to take all the new money out of the policy and just keep going. And so we can just keep seeing what's it going to look like. Maybe I scroll on down to year 10. If I just for many, many years, what does it look like at year 10? Well, up about 120,000 in my investment from continually reinvesting and adding gains. I'm building a yearly gain of about 15,400. And so at any one point, you could say, you know what, I don't want to invest anymore. I will now want to use this for retirement income because we've built up $128,000 of investment capital, generating about $15,000 of gains. And that's maybe this at the end of the day, we're going to cover some of the loan interest, or maybe we pay the loan back with something else we have. But anyway, this is just going to allow us to see what would an investment strategy look like if we're using policy cash value. What if we use some cash? What if we use some lines of credit as well? So really just the ability to model this out. So think of everybody that's in the debt situation right now. We want to get you to this point. We want to get you out of debt. We want to build wealth while we're getting you out of debt. Then we want to take that wealth and build more wealth, because the last thing we want to do is get out of debt and go back into debt 3 to 5 years later. This is exactly what Stephen was saying earlier. We have a path that can change how you pay your debts so that we can do these types of investments later. So anyway, those are some of the things that we like to teach. We like to show people. These are the things we do personally. But it does require having some patience, pouring that water on the dirt, and having your family and your neighbors and your friends saying, why are you pouring all that money into that stupid whole life policy? Because one day that's going to shoot out of the ground and you're going to be doing some really cool things with your compounding and your investments.
I love Shauna put it this way. She said, giving up early cash flow isn't a loss. It's an investment into your own leverage.
Mhm.
I thought that was a good way to say it.
Absolutely. So I know there's probably some questions, especially for the new people. We've got the ability for you to connect with some of our money mentors now. We can, connect with you later. And Stephen, I don't know if you want to talk about, because there may be some people that came in late. Do you want to talk about the event again coming up? Because we're just going to dive even deeper
Yeah,
than
we
what.
got a whole bunch of stuff to send out. That's what we were just doing while you were talking, Craig. We were getting all the mystery box stuff ready, taking all the sizes down that everybody submitted. So again, this weekend, starting tomorrow, we've got our blueprint event. So it starts tomorrow, goes through Saturday. Pretty epic thing. I'll have Stephen explain that. But I made the offer of saying the first two people, which obviously that ship is sailed, get a deck, but then everybody else gets a mystery box, which is going to be one of the shirts on the website if you go on there and look. But Sean is going to pick. We just need your size. So everybody gets some. Okay. So if you buy a ticket, to this weekend's training, I don't care if it's GA or VIP, you get something in the mail, but we're not going to show, we're not going to tell you. There's going to be a surprise, but I think you're going to like it. Steven, you want to talk a little bit about it?
Yeah, I mean, it's taking basically our top trainers, what we teach and putting into a no fluff, no holds barred, 3-day package. And it's in a very coherent way, starting with tomorrow morning at 10 a.m., Thursday morning, talking about the mindset of infinite banking, why it's so important right now, especially in this market and economy that we're in, to be able to understand where your money is, how money works, how to eliminate the wealth killers from your life. And, we go right through the next 2 days talking about becoming your own banker, different strategies for it, different ways to look at it and understand it and apply it and implement it. And then, building wealth on day 3 on Saturday. So this thing is going to be, it's an awesome training. It's going to be a lot of fun, and I'm looking forward to having everybody on over the next 3 days. So
Awesome.
grab a ticket and be ready to go. And if you missed it earlier, though, it is 100% money back guarantee. The VIP ticket is $97, and it comes with the recordings, the bonus sessions, the bonus goodies. Everybody gets a digital workbook that's actually very well. I mean, quite frankly, I have a lot of digital workbooks. And I keep a whole knowledge library over on one side of my office with books and notepads from the past and different workbooks that I've accumulated over all the years. And so the workbook itself, I mean, is worth $97. I've seen those stuff like
Yeah,
that
it's
go
pretty
on sale.
epic.
So you're going to get all of that, but it's $97. So go grab a ticket. And if you guys need anything at all, just give us a shout.
Yeah, if any of you are getting your tickets today, make sure we know your shirt size. We'll get it over to Shauna. And even if you do get a ticket, but you do it after this, just email Shauna or just put it right in your order when you buy your ticket. Just tell us what size you are, and we'll get that taken care of. But it's been a lot of fun today, Craig. Great job with the parable and all the examples. And I love that you get to showcase the beast of a design. Nobody really understands how difficult, a truly like near impossible difficulty to create the gains projector inside the vault. That was literally, that was moving a mountain. That's the only way I can say that. It was very hard to get it done, and I love that it's completed, working. People are raving about it. Craig's using it. So, folks, if you are not familiar with the vault, get on one of their calls, get on one of their trainings. They love it, and you will love it as well. But for all of you, thanks for joining us today for Wealth Webinar. And we will see you this afternoon for Ask Me Anything Happy Hour. The recordings for this will go up on Saturday. So if you missed it or you want to rewatch this coming Saturday, this will be up on my YouTube channel. But you know what? All of you will be at the live event. So we'll see you there. Thanks, everybody.